So today we are going to answer a commonly asked question around cash value life insurance on the topic of policy loans. So if you take a policy loan out, do you have to repay it? Do you have to pay back loans? And the short answer is no. You are not required to repay policy loans in a life insurance policy or contract. With that said, it often does make sense. If I am using the policy and plan to borrow, repay, it can often make sense to repay loans when you look at the numbers. And then also what I want to add here is if you take the maximum loan against your policy, so you have $100,000 in cash value and you borrow against it, you borrow $100,000, maybe it's $98,000, whatever the maximum allowable loan is, that's what you loan, and you don't pay the premium, you don't pay any loan interest, you don't apply any payments toward that loan balance. That would be a situation where if you don't pay anything back, the policy would lapse. So that means it would terminate. And for some additional awareness there, if a policy lapses with a loan on it, and I had a gain, meaning the cash value was greater than what I had paid into the policy, that could result in a potential taxable event. Now there's more to it. We've got some videos and content that really dive deep into that point as far as what can trigger a taxable event. But back to this question, do you have to pay loans back? The short answer is no, but I do want to be aware of what could potentially happen if I take out too much, if I borrow too much against it and don't pay anything back, I could run into some issues. Then second, if I take out a loan and don't pay it back, is there a big impact? And the answer is yes, but again, it depends on what I'm using it for. I'll add that a lot of people will often use policy loans in retirement, really as a means to generate tax-free income, and they don't pay anything back. When you look at how corporations use high cash value life insurance policies, and especially as they start to pay income out to their retired executives that they originally put the policy on, they're using cash value life insurance, they're often taking loans against the policies, then making those payments to the executives, but they're not paying anything back, no interest, nothing against the policy or repaying the policy. But it does have a big impact on it, so I want to be aware of that up front. A great way to build awareness, and this is something we love to do as a company. We do this for everyone we work with whenever they want to see any type of loan scenario, whether it's during the initial education and sales process, or if it's during the review meetings after they have a policy in force. We want to keep in touch with them forever as we reach out every 6 months. Whenever I'm looking at a policy in respect to loans, what I like to analyze is first, what does it look like when it is designed for maximum cash value? Make sure that that is set up properly first, optimum cash value. Then, when I take that exact same policy, what does it look like when I just let it sit and grow over time, compared to the same scenario where I take out policy loans, I repay it in full, I only pay the interest, and then I don't pay anything back. What we're going to look at quick here is an actual case study. This was an individual nearing the age of 60 that had a large sum of money, and he was looking to put it into a policy, then borrow it out, purchase a nice piece of real estate. It was a home him and his wife were moving in, and that's what he wanted to do. And he said, hey, my understanding is that the dividends will wash out the loan interest. And as we're talking, I'm like, that's not going to work like that. But I can explain it to him. That's really what he wants to do. So rather than just explain it verbally, we put it together. This way he could see what the advantage of the product would be from a pure growth standpoint. And then also what it looks like when he takes out loans, pays it back, pays interest only, doesn't pay anything back. And these are max loans he's taking out of the policy or close to it. So we will see a potential risk here as well. That's the kind of awareness a consumer must have. We don't want to just see the best case scenarios. This is where buyer's remorse comes into play with any product in any industry, but especially with whole life insurance when you're dealing with people's money here. So again, actual case study, age 58. Here's a loan and repayment model. Best case scenario first. I usually like to start with the worst, but we're going to look at the best first. What we've got on the left, growth. What it looks like if he just pumps money into the policy, significant amount of money. Well, how much do we see there when we tally it up? $2.5 million going into the policy, $500,000 per year. Well-designed, minimum premium, maximum cash value. Breaking even, between years 3 and 4. By year 4, he's paid in a total of $2 million, and he has $2,031,000 in cash value. Then we've got his annual internal rate of return and his average internal rate of return. So not just the gross dividend rate, but what his policy is actually growing by. If you're new to these terms, the annual IRR represents what you are growing by year over year. So for example, if you were to compare this with the stock market and said, hey, last year in the S&P 500, I earned 30%. I invested at the perfect time. I did really well this year, 30% annual IRR. This year, the policy, and when I was 65 years old, I earned 4.84%. That's what I earned that particular year, the annual IRR. Going back to the stock market example, what did I average out over the past 30 years? I averaged 7, 8%, depends on the time period. Average IRR, what did I average out? Over 10 years, 3.5%. 20 years, 4.14%. Now, refresher on this, cash value life insurance is what? Core benefits, safe, liquid, tax-free if you do everything right. So that becomes very, very attractive to so many people, especially in higher tax brackets. So why I like to look at this whenever I'm taking a loan against the policy is because it allows me to see what the policy is actually growing by and then what I'm actually paying out in loan interest. Don't try and mask the fact to say, hey, look, you're earning interest on everything and only paying loan interest on the outstanding loan. That's true, but show people the numbers. This has helped our business grow so much by providing transparency and showing the worst case scenario to people. That's what they want to see. I like to see it. So here we go. You've got the $500K for 5 years, annual loan, taking out a total of $2 million. So he's paid in 2.5, he's loaned out $2 million. The years he takes out the loan here, he is going to pay the loan interest out of pocket. So $500,000, there's the loan interest at 5.66%, and he pays it out of pocket. Okay, as we go through year 5, when he's still paying the $500,000, there's the loan interest, the 5.66% on the total balance. And then he begins to chip away at the balance. Loan repayment, $500,000 per year. Got some capital to work with here. And he's making the interest payments out of pocket. So I want to tally all of that up. What I really like to look at and provide transparency on is this. Here's the cost to borrow, or the loan interest that is being paid to the insurance carrier, and here's what you're actually earning on the policy. Sometimes people say this and state, well, why would I do this then? Because they are very concerned about the actual earning rate compared to the loan rate against the policy. And that's where often those cash value collateral loans come into play, where you will get a much more attractive cost to borrow that in this case would be at least 3%, could potentially be a bit lower. And now all of a sudden it makes sense. But again, options and awareness. But loan repayment, when I pay it back, cash value keeps on growing. That's all well and good. And I've got a big pile of money. Next option, I borrow and only pay the loan interest. So here, on the left, you see the exact same thing, growth model. Any loan scenario I look at, I like to see the growth model next to it because it allows you as a consumer, as a potential consumer, or if you have a policy already, to see exactly what it would look like side by side. Because if I just show you this, I'll say, okay, I can loan out, pay the interest only, and I still have some equity over here. But if I've got this next to it, I can see, okay, I take out $2 million total. If I didn't touch it, I had 2.6 million in cash value. Here I pulled it out. I've got about $600,000 left in equity. Okay, so I lost about another $17,000 in that example. Where'd that go? We've got videos that break that down. But still, like that's the kind of stuff I like to have awareness on. So here, cash value continues to build in this example, and it always will if you're still paying the loan interest because you're covering the drag. If you don't pay the loan interest, which we will look at next, what happens is the policy borrows from itself to cover that loan interest. But here, there's the annual loan interest. You're covering it. Now, get ready for a nice little surprise. This is a company that actually lowers the loan interest rate after 20 years. Check this out. It's a fixed rate too. Now all of a sudden, that looks good compared to the IRR. But still, I want to see that up front. Some people would say, who cares? It's 20 years down the road. I want to be able to deal with it now. Loan repay, okay? Or I'm sorry, no repayment. Here's where awareness is critical. Same thing. Growth model, identical. Loan model. There's your loans coming out. Now the first year, loan balance actually nets out to 6% on the loan rate here. So I got to correct that, but still, here we go. We're not paying any loan interest out of pocket. What do you notice happening years 6 to 10? What's happening to your cash value? Your out of pocket is 0, so you're not paying anything. But look at this. Cash value is going down. Then all of a sudden, year 11, when he is 68 years old, in the premium PUA column, so the software will warn an agent about this, but what happens here is this $39,000 and change is a payment that is required by the policyholder that must be made to keep the policy alive. If dividends come down or the policy doesn't perform as originally illustrated, which often happens with whole life insurance, that would be higher, or it could happen a bit earlier. This piece right here is so important to make people aware of. Even if they can easily make the loan payment, life happens to everyone. I've seen it with individuals that put in 5 to 10,000 per year and people that put in 6 figures, close to 7 figures per year. Things happen. Having the awareness up front prevents that situation of, oh, I didn't know that. I would have planned differently if I had the awareness. That's the key right there. So that's a no repayment scenario. Does not look quite as attractive. So going back to our questions, what were they again? Do you have to pay back loans? No, you don't. But if you take out the maximum loan, like that last example, we can run into some issues. Now, if you're taking it for retirement, which does sometimes happen, it is very easy to model exactly what's the maximum you could pull out without ever have to worrying about a risk of lapse or anything like that. And you do that by running a conservative dividend and the guarantees. And then this guy, is there a big impact if you don't? On your cash value death benefit, yes, there is. So hope this one helped. If you have any questions, please feel free to reach out anytime. If you enjoyed it, please hit the like button, subscribe for more, and we will talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.